Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for attending. I greatly appreciate the viewership, the subscribers, and always the comments in the channel. I love the discussions going back and forth around finance, market multiples, this company, that company. I love it. You guys are challenging me in my assumptions, which I think is fantastic. Nobody knows everything or what's going to happen in the future. So by all means, question me, tell me what you think, give me sources that you think for forecasting. I'm always happy to take those as well. This episode, we're going to look at Tyson Foods. It's been beat up recently because of their real terrible response to the COVID situation in the United States. They've had several plants that have big outbreaks. There have been a couple deaths, very unfortunately, with employees. That means potential lawsuits, and they're spending a ton of money trying to defend themselves as well as get caught up on compliance. As a result, it's hurting their financials, and the market is beating up the shares. Let's take a look, see what we think. Before we dive in, I do want to thank a viewer for the recommendation. This came from the channel. Definitely do it for you guys. Appreciate that. As always, we look for 5 key attributes for all of our investments. That's top line revenue growth, earnings growth is EBITDA, strong free cash flow, low debt, meaning less than 3 times debt to EBITDA, and a well-priced stock, well-priced being EBITDA to enterprise value divided by EBITDA. That's got to be a good market multiple for us to be interested. This channel, as everyone knows, we are seeking cash flow. That's the underpinning for every investment. It is not a dotted line, it's not a green line, a bar chart, nothing like that. Head and shoulders, none of that garbage. We buy cash money. So let's take a look at Tyson Foods, see what we think they are and what we think. Ready? Let's do it. Let's dive right in to the actual financials. I went through the 10K, which is behind me. Their fiscal year ends September, so they've just filed their 2020 annual report. All these numbers are in USD in thousands, and fiscal ending 2020, September 2020. All right, let's go. Revenue. Revenue was $33 billion to $43 billion over this 9-year period of time, which is extremely low. It's positive, so it does technically check the box for us at a 3% growth rate, but it's nothing really to write home about. And if you look at this period in here, it's really, really low. And then it does tend to kind of grow in the outset. If you look at the 10K and you go to page 30, and you're talking about right here, they do a very good job doing a year-over-year comparison of what happened to all the key metrics in the business, which is kudos to Tyson for breaking that out. But you can see they're talking about sales revenue year over year for 2020 to 2019 and 2018 to 2019. And what they talk about is that the volume that you see, the sales increase is driven by volume, which is great. That volume is driven by acquisitions primarily. They bought 2 companies. They bought a Thai food company, and they bought Keystone a couple years ago. Both of those added revenue and unit sales that is representing this growth here. So it's not really organic growth from their existing businesses. It's really buying other companies and bolting them on. It's a process called bootstrapping, which I'll talk about here in a second, but I want to cover the fact that this growth is manufactured. They're buying it. So then it's about how much they're buying it for. Is it a good return on investment? We're going to get there. But I want to finish out the picture, and then we'll talk about the company. EBITDA. EBITDA, they actually break out EBITDA in their 10K, which I really liked. It gives the stack up. I won't look at it. You can go find it in there. What I've done is I've taken their 2020 EBITDA number, and I've added to this $540 million, which is the amount of money they spent in COVID compliance in 2020. Because that's a one-time expense, long-term, that should go away, and it should be represented in their kind of run rate EBITDA. That's what I want to use to forecast. So I want a normalized, if you will, earnings. So when I do that, they're just shy of $5 billion in EBITDA. I'll show you here. And then you've got a 14% annualized growth rate with a very strong performance this last year. Again, mainly from the acquisitions that they've been doing. Let's look at enterprise value, debt level, and see if those check the box. Debt level has gone up $2.4 billion to $11.8 billion over this time frame, which is pretty strong growth given fairly, actually pretty decent EBITDA growth. EBITDA is almost 3x what it once was. Maybe, 2.5x. Market multiple, market cap is enterprise shares outstanding times price. Market cap was $7.4 billion, has grown to $32 billion over this time frame. Enterprise value, basically adding debt, adding market cap, less cash outstanding, is just shy of $10 billion, all the way up to $44 billion recently, which is actually a very, very big move over this 7-year period of time. For a food company, that's remarkable. Let's see what's going on. One last comment. I didn't see any excess cash on the balance sheet. There's a little, but it wasn't germane, so I skipped it. Let's take a look at the debt. So net debt, this is debt outstanding, both long-term and short-term notes or financial lease obligations, right? We're not pulling deferred revenue or some of the other line items. This is purely bond debt obligations. Net debt, 1.4 times up to 2.4 times this last fiscal year. Technically that is less than 3, so it meets our criteria. I don't like that it's growing, but I think it's growing because they made 2 big acquisitions. Principally, the Keystone acquisition was in 2019. I think it fell. It was 2018, but their fiscal year is a little different, so I think it represented itself mainly in 2019 numbers. So you can see the high point at 3, but then they quickly brought it down as they paid down debt, and that's good to see. So I think that checks the box on the debt level. Let's take a look at the enterprise value. Here's pretty interesting. So earlier in this time frame, you could see on a low point for 2 years, this company traded at 5 times EBITDA to enterprise value. That is very, very cheap. It then quickly shot up to kind of 10 range-ish, and then it's been hovering around this period for some time. Recently, with the COVID and lawsuits and issues, the stock has come down. I think it's roughly $65 a share now, which puts it about 7.2 times enterprise value to EBITDA, which is a little low from its average, but not materially different. So it's kind of on the cusp of being a great deal. It's definitely not overpriced. So I think we can say it's not too expensive. It's probably fair value on the hair side of cheap. Okay, before we get to cash flow, let's talk bootstrapping. What is bootstrapping? Why is it important? Well, bootstrapping is the process of buying up other companies, consolidating their earnings onto yours, and trading on the multiple that you receive versus the multiple you bought the company at. What? Okay, fine. I'll give you an example. Tyson Foods in this line is traded at 9 times EBITDA to enterprise value. That's their value of the company. The stock gives them 9 times all EBITDA that they generate to equal their enterprise value. So if Tyson goes out and buys a company, let's say they pay $1 billion for a company and they bought the company for 5 times EBITDA, then the EBITDA that they receive from the acquisition gets folded into their numbers. They purchased it for 5 times. Once it's folded and consolidated in their financials and they report to the street says, hey, for every dollar of EBITDA, you get 9 times of enterprise value. That means they buy it at 5, they consolidate the EBITDA onto their numbers, and the street instantly gives them 9 times that same cash flow. That expansion is bootstrapping. It's a huge principle that private equity uses, and lots of corporations use it to go buy up companies. And Tyson Food is no different. What I wanted to caution you about is when I read their announcement that they purchased Keystone, this was back in 2019. They bought the company for $2.5 billion. Fortunately for us, they gave the EBITDA that the company generated, which was $211 million as an adjusted EBITDA number. That is roughly 10 times enterprise value or purchase price to, because it was a cash deal, to enterprise value to EBITDA. Well, the problem there is that in 2019, when they did the deal, Tyson Food is trading at 8 times. So this is the reverse of bootstrapping, unfortunately. So they are paying a premium for businesses for 10 times, and the street's giving them credit 8 times. So they're losing value when they do this. It's not a good thing, and I think it's unfortunate that they trade at such a discount that the street's not giving them much credit for the revenue that they're able to generate, the earnings that they're able to generate. So that's one caution. I like that management is going out in the world and buying to grow. Unfortunately, until the street really catches hold, you're not going to see a great value multiple, I think, on the business, certainly the bootstrapping. It just hasn't been reflected in their numbers just yet. But it's a point I wanted to make. Let's take a look at cash flow and see if cash flow lines up with the income statement. So, cash flow from operations, you know that's my favorite statement. You've got 2012 to 2020, cash flow from operation 1.1, call it 1.2 billion to $3.8 billion the most recent fiscal year. That's a 16% annualized growth rate, which lines up well with the 14% EBITDA growth rate. So the P&L and cash flow statement are lining up. That's good to see. This growth here recently from like say 3.6 to 3.8, that really is the Keystone acquisition with a little bit of growth from the organic business, but mainly they're buying cash flow. Again, paying a 10 times multiple, receiving a 9 times multiple. Not great, but not terrible. They're not overpaying by too much. Should they actually catch a bid and the market multiple go up, they'd instantly get that acquisition would be accretive. CapEx is not too large at all annually on the cash flow that they generate. So every year, cash flow from operations is large enough to more than pay for the CapEx that they have to reinvest in the business. They don't have too much debt, and they do some. It's not, for our metric, isn't too much, but their debt payments aren't huge, so that a lot of this free cash flow ends up passing right through to the cash flow from operations. And they do generate strong cash flow. It does not appear that they need to put back too much money into the operation, into their plant and facilities to be able to generate their business. Most of this free cash flow they are actually using for acquisitions. That's how they paid cash for the Keystone deal. I think they put a lot down on the Thailand company that they purchased, which had operations in Europe and Thailand, I believe. So I would imagine going forward, they'll continue to buy businesses and use this free cash flow. And hopefully that means that their growth rate is going to be higher than the growth rate forecast I'm going to give them. Because I'm going to assume that all this cash is dividended out to us. So I can't reflect an EBITDA growth rate that we're seeing of 16% because that cash is assumed to be distributed. Let's keep going. Shares outstanding. Shares outstanding has been flat over this period of time, mainly because of the acquisition. They had to issue shares. If you go back in time prior to that, they were using their cash to buy shares. You can see here 400 million shares down to 367 million. That is a good trend that they were doing until they found acquisitions. Then they said, you know what? It's better for shareholders to go buy companies, expand internationally. That's what they're trying to do, expand globally. And they've been redirecting those funds rather than buying and canceling shares for growth, which is great. We're seeing it in revenue, we're seeing it in earnings. The street's not really giving them too much credit for it yet, so let's keep going. But that's why it's really flat the last 3 years. Free cash flow per share, strong number. This 2019 here, they had a large debt inflow, so that is causing this cash flow to be artificially high. It's not, that's producing a 16% free cash flow yield, which is abnormal. It's really in this 5 range to 6 range. I think these years here, this one and this one, truly reflect, operating the business, putting cash back into CapEx, and making a principal debt payment down to bring down the debt. What's left over, $1.5–2 billion. That's kind of the trajectory, which I like to see. But we'll finish this chart. Here's the yield, like I covered. I think this year at 6%. This year at 4.8. Even in this year are more reflective of a run rate free cash flow. It's not being distorted by borrowing too much or paying down too much. Kind of an average. Lastly, ROIC, weak double digit, but definitely above their borrowing cost, which in these environments is very low. Okay, I think we can now forecast forward. What we're going to do is I'm actually going to pull a couple things. I'm going to look at revenue and just say if revenue is growing at 3%, that they're going to be able to push a slight increase in earnings at 3% a year. I'm not going to use the 14% that they've experienced over time, again, because that's largely due to acquisitions that they have made. And we're going to just assume that most of this cash is distributed out. So if they can make a profit growing at 3%, that seems like an interesting deal to me. So what I'm going to do is I'm going to pick up the EBITDA target that I showed you earlier, where I've added back the one-time COVID $540 million, and I'm growing that at 3%. When I smell check this with some of the other statements that they have said that they believe they can squeeze out in cost savings $160 million of cost savings for the Keystone acquisition by simplifying management. This lift from what I had last year to now is roughly $160 million. So just on the synergies alone, I think they can hit the target next year. And then if they're able to grow with inflation, with a little cost cutting, a little extra volume growth over the time, I think it's a conservative forecast. And I want to see if they can pencil out at this number. So what I'm doing is I get a growth forecast out 10 years, which if you're an equity owner, you have no idea what the business is going to do. If you buy it, you need to be buying it for a long term. So that's why I use 10 years. Obviously, I'd love to hit these numbers in 5 years, and my IRR goes through the roof. But as a default, if the stock goes down and you're stuck in it, you might be stuck in it for a long time. So I use 10 years. That gives me $6.7 billion of EBITDA out a decade. I'm giving this an 8 times enterprise value to EBITDA number, which is a low number. It's basically the historical average that they've had. And you're saying that they're at 7 times right now. Going 8, you get a small lift in the EBITDA market multiple, but it's not huge. It's definitely not declining like we see oftentimes with the growth stocks that we review. As they get big, that EBITDA comes down multiple. Less some debt, no cash, gives me a market cap $38 billion, less current shares, divided by current shares outstanding. I have a price target of $103.95 out a decade. Same thing for cash flow. If I look at cash flow, I'll pull, this is actually pulling last year's, so 2020's free cash flow after the debt payment that they made because they had to bring down the debt level a little bit. I liked that. That gives $5.67. I grow that a decade at the same 3% growth rate over time. I get $7.40 as a long-term target. I'm giving this a 6 yield, and that gives me a price target of $123 a share. Okay, now we've got 2 price targets. Let's take a look at what does that look like when we stack up the 2. So I've got $123 from our free cash flow model on a yield basis. I get $104 on an EBITDA market multiple basis with a little bit of market multiple expansion. I get an average price of $113 out a decade. Okay, I can buy it now at $65 a share. We'll put this in our IRR. Again, I'm assuming that all of this is distributed out for the simplicity of this math. If they kept it and they went and bought a company, I hope that they'd grow faster than 3% growth in EBITDA, which is what we've seen historically when they were growing at 13%. So I kind of like this approach. This gives me a summation of cash flows. $65 out gives me a stream of cash flows. I get sell it for $113, and this produces a 16% IRR, or just shy of 3 times your money over that decade. Which is a very strong return for a company that makes chicken and poultry and pork. So it's not like this is a software company that's going to be growing by the leaps and bounds. To get what could be a market-beating return over the next decade, I think is very attractive. I certainly like the diversification play here. If you are in a lot of tech, a lot of growth names, I think the value sector is underrepresented by people's portfolio, and I think the great era of stock picking is upon us. So I would definitely go value hunting. I'm not sure I would pay too much more than the 65. You've got some litigation that's coming, so if they have to settle or there's a big loss, a big firm goes after Tyson for a lot of money, that's going to put downward pressure on the price. And I think it would be a great time to buy. Let me show you one more thing here. Last year, their enterprise value is $44 billion. Right now, it's $35 billion. That's a 10 billion haircut, and $9 billion haircut, which is tremendous. And I can't imagine a lawsuit or COVID compliance or any of these things adding up to that type of haircut. So I think that this new pricing you're getting is taking a lot of the downside risk of the company away and leaving potentially upside over the long term as COVID gets behind us, as they maybe tuck in a couple acquisitions, maybe get some synergies. I think there's some upside here. Let's take a look at the distribution curve. Like I said, you're at $65 now at 16%, which is a market-beating return. If these numbers hold, they're my assumptions. Check your math, do your own assumptions. But if that holds, you make 16% over a decade, which is fantastic. If it goes up, as it goes above 70, kind of gets back into that premium range, I think you back away from it. The upside isn't just there. Even though it's double digit, it's still a food company, and it's really not going to grow that much. So I want something that has a lot more room to run on the price if the unit volume of sales can't move like a software company can move. Obviously, if it comes back down below 65, in my opinion, it becomes a big buy. Let me give the card. The official rating is good. This is Tyson Foods. A little quick review of their cash flow. Let's recap our 5 metrics. So top line revenue growth, yes, it's 3%, it's growing. Earnings growth with EBITDA, yes, 13%, it's growing. Strong free cash flow, absolutely. There was low CapEx, so a lot of free cash passed through. Low debt, yes, less than 3 times debt is a good position. And well priced, yes, I think it's well priced given the recent pullback, the COVID news. You're going to have to hang on to this for a while. We don't know what's going to happen with the lawsuits, with compliance, with costs associated with compliance. So I think there's a little bit of turbulence there you're going to have to weather through. But it seems like it's a stable company to me, and it might be a good diversification play if you're looking for that. My name is Cameron Stewart. Thank you very much for watching Rational Investing. This has been Tyson Foods. I greatly appreciate all the comments. Don't forget to hit the subscribe button, and thank you. See you next time.